I think we clearly can see from the year-to-date performance on equity markets that the market takes it cautious. We definitely see that higher interest rates leads, of course, to a repricing, and in particular, repricing of the growth-exposed stocks, in particular on the tech side. And I think that's what really has dragged down the markets in the US, but also here in Asia and globally overall. And we do think this is more an adjustment process. So I think if the underlying growth remains robust, despite higher interest rates, this readjustment process on repricing of inflation will be temporary. We also do think that inflation should roll over, particularly going into the summer months of July, August, and September. And then maybe also we will see that the phases start to slow a bit the pace of higher interest rates. But overall, I think for the markets, it's a challenging environment, probably until we get this first interest rate hike. But there's upside for equities overall. Earnings remain strong, underlying growth remains strong, and therefore we actually remain positive on equities overall.
Yeah, and it's fascinating because we've already seen quite a big adjustment to equity positioning through January. So the outlook leading into what could be the first rate hike in March is still quite uncertain at this point, as you say. So Adrian, what is the strategy that you're putting in place as we come out of this period of high inflation, high growth to more moderate growth, more moderate inflation moving forward?
For us, it's clear that the way we position the portfolio tactically is really going after the cyclical exposure of the markets. So we overweight Europe, for example. Our top call is energy stocks, and has been a top call for a couple of months already, best performing sector year to date. And I don't think it's over yet. We have seen very strong earnings numbers from the US energy companies. The European energy companies report over the next 1 or 2 weeks. So there's further upside, particularly looking at where oil is trading. We see that the inventories are quite low, so there's big demand for energy, and it's also a good hedge against geopolitical exposure. So being more cyclical, having financials, of course, as well, which are benefiting from higher interest rates. Another strong performer this year, particularly European financials, are looking attractive at this point. And then, of course, we want to start to look a bit into bottom fishing of some of the tech stocks that have already derated and adjusted for higher interest rates.
Adrian, it's Hadley out in Abu Dhabi. You mentioned energy prices, WTI crude sitting above 92, Brent crude above 93.50 at this moment. Obviously, it's not even summer yet, and so there are a lot of fears, obviously, that we could see oil over 100 in the short to medium term. What's your take on that one, given all of the geopolitical risk? How's that weighing on your strategy?
Well, we do think that oil still has upside from here, particularly tactically, and maybe also overshoot. So it could be that we see the $100. We don't think at the end of the year we will be at $100. We actually do think we're sort of in the range where we are currently. That's where we probably see WTI and Brent trading. But in the short term, of course, there's pressure. And then there's, of course, this big uncertainty on what's happening with the Ukraine issue. And if there's an escalation, of course, oil can spike much higher. So I do think it's a very good hedge as well as a base case position in our portfolio. But it actually also has these features that it basically also can protect against an escalation on the Ukraine side.